be aware of is where else are investors going to go? Equities is really the only game in town in terms of building some source of appreciation. And if you're a long-term investor, as our clients are, I think you can ride out this volatility, but let's make no mistake. It's going to be volatile for a while, given these geopolitical risks. But the equity market, I think, still holds now lots of opportunities for investors with a long-term view to get some exposure to secular growth, even if the economy slows down. Even in a recession, there are ways to build in some insurance against some of these risks that we're seeing now, whether it's defense names, cybersecurity, energy. There are a lot of ways to build insurance into portfolios in this kind of environment.
So, Joanne, what you're saying kind of echoes what our colleague John Authors wrote in his Bloomberg opinion piece today, that is essentially, yes, higher yields in theory can threaten equities, especially those that command higher multiples. But at the end of the day, a more aggressive Fed is going to be worse for bonds than it is for stocks. Is that essentially the thesis you subscribe to?
Yeah, I think that's a fair statement. And I think we have to put the interest rates into perspective. First of all, interest rates at 2.5%, 3% is still incredibly low. Historically, it's still a relatively cheap source of funds. And remember, corporations tend to borrow longer term, so they're looking more at the 10-year and the 30-year. And those seem to be anchored by Fed credibility. And clearly, the market does expect inflation to come down, and that's why we're not seeing such a buildup in rates at the longer end of the curve. And also, we have so much demand for the 10-year globally because it's the safe harbor, because pension funds have to be there. Central banks are going to be there. So I think that helps to anchor the long-term cost for corporations, which does suggest more investments, more expansion. Job openings are still at record highs. And so I think we're still going to see expansion on the production side of the economy, even while we see some constraints on consumer spending.
Joanne Feeney, always fantastic to catch up with you, of Advisors Capital Management. We kicked off the conversation on banks, Lisa. Doug Cass wrote in straight away and talked about why he thinks there's limited upside for the banks in America, even with this drift higher in yields. Domestic growth is about to slow. His view, the Fed seems destined to tighten into a domestic slowdown. Again, his view, his quote, the modest improvement in low demand over the last few months he thinks will likely fizzle, and he thinks the trade has grown too popular. After a lengthy period of outperformance, they are everyone's go-to value stocks.
So there are two sides to this, obviously, which is the reason why you have a market here. But you have, you can add to the potential risks there that capital market activity is slowing down. You're seeing companies struggle a little bit more to raise money. On the flip side, banks earn so much from the income on deposits that they're finally getting. The fact that 2-year yields are above 2%, that they can actually get yield, that income story gives people a buffer to sort of filter into this TINA argument, that there is no alternative.
Well, this is what Doug says. Where else are equity investors going to go? And he says 2-year notes.
At what point does the Treasury yield end up enticing enough investors, not only from the United States, but also globally, especially given the divergences that we're seeing between the U.S. and Europe and the U.S. and Japan?
2% in a 7%, 8% inflation world. That's pretty tough still, Lisa.
Well, yeah, it's pretty tough. However, you got to imagine that the economy is strong enough to withstand any kind of rate hiking cycle. And that's the bet right now, fueling this there is no alternative debate over stocks, and frankly, the bet that a lot of people are making, because they're saying they will continue to make money, as we saw from Nike, as we saw from a lot of companies that have reported earnings, even as bonds struggle in this inflationary environment.
Without a doubt, what you just said is what divides the bulls and the bears right now, Kayleigh. Whether the economy can handle this tightening cycle or not, even if they have to go more aggressive, even if they have to front load 50 basis points, 50 basis points.
Well, and if that is what the market heard from Chairman Powell on Wednesday, more so that the economy can withstand whatever hikes we do, less so that Powell sees that as a reason why they can be aggressive when it comes to policy. Maybe that is what the market misread last week, and that it got a little bit more clarity on yesterday, John.
Perhaps the economy will be okay. Lisa, maybe the market won't be.
Yeah, and actually we've seen for so many years that the economy hasn't been that okay and the market has been. So do we get the reverse?
Futures up 1/3%. This is Bloomberg.
Omicron variant and the latest wave have an impact on not only consumer trends, but your business? And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Away from the opening bell in New York City this morning. Good morning to you. The shape of the price action looks a little something like this on the S&P. Up 1/3% on the S&P, on the Nasdaq up 0.2% since 2:30 on Wednesday, which is when the news conference started for Chairman Powell. The equity market, the S&P, up almost 5 percentage points. Just looking right the way through what may or may not happen with the Fed funds rate over the next year or so. This is the story in the bond market now. Things starting to get really bunched up. Let's take a look at 2s, 5s, and 10s. You'll notice the 5-year above the 10-year at 236.37 on 5s, and 10s at 234. And you'll notice the 2-year is getting closer and closer to the 10-year. Some flatness and some pockets of inversion here and there as well, and this equity market still doing okay in the face of it. We'll pick up on that in just a moment. Elsewhere, Lisa, if you're looking at a yield curve, you can look at 5s, 30s, but we look at 2s, 10s, don't we? 17 basis points, and you can see the trend of the year so far. Are we pricing a slowdown in? I'll tell you what we're not pricing in at the moment in the bond market is anything that looks like a soft landing in this Treasury curve.
That seems to be the consensus increasingly among bond traders. I don't know that the stock traders have gotten the message. I do wonder, though, how many people agree with Jay Powell that a curve inversion this time around is different than prior cycles simply because the Fed is hiking into a more robust economy rather than incredibly late cycle.
Chairman Powell teeing it up. Goldman Sachs says, let's go. My words, not theirs. Jan Hatzius is a lot more diplomatic than that. He just says simply a 50 basis point move in May, and potentially another one in the meeting after that. That's the cross-asset price action. Let's get you some single names. We can do that this morning with Kaylee Lyons. Good morning, Kaylee.
Good morning, John. Well, one company we are continuing to focus on this morning is Nike. Reported earnings after the bell beat revenue estimates across the board, across all regions, including China, where, yes, sales were down, but by less than expected. Really, the story here is one of it working through supply chain issues. The company still saying that demand is outstripping supply, even with a 15% build in its inventories. That stock is up about 6% before the bell. I wanted to check on Boeing as well because, of course, it fell 3.5% yesterday after that Boeing 737-800 NG jet with 132 people on board crashed in China. Investigators still trying to figure out the why behind that. Boeing shares at the moment are essentially rebounding just slightly, up about 0.2% in early hours. I wanted to point to Okta as well. This is a application software company, operates authentication services for companies. A hacking group, Lapsus, says that it has hacked and done a data breach of that company's systems. Okta saying that there was actually an incident in January. There's no ongoing sign of malicious activity. Still, though, that stock is down about 7.5% before the bell. Finally, I wanted to take a quick check on Alibaba and other Chinese ADRs, how the action is here in the U.S. Alibaba overnight announcing a boosted buyback program of $25 billion. Actually, the second time in the last year it's hiked that program. Maybe a sign of optimism about the easing of the regulatory crackdown from Beijing. Alibaba ADRs up 8% in early hours. And you got JD.com and Baidu each moving higher to the tune of about 5 or 4%, John.
Kelly Lyons, thank you very much. We talk about this often. When the chairman speaks at a news conference for the Federal Reserve, he's got to reflect some form of consensus. When he speaks in a forum like he did yesterday, he's speaking for himself. Ian Lingen joins us now, the head of US rate strategy at BMO Capital Markets. Ian, what did we learn when we heard from the man himself speaking for himself?
Well, I think that the primary takeaway from yesterday's comments from Powell was that he is actually very open to the idea of a 50 basis point rate hike. We've now seen that reflected in the market. As you pointed out earlier, some calls have been changed. People are looking at May saying 50 basis points starts to make a lot of sense. And let us not forget, we're also going to see the balance sheet runoff as soon as May, if not then June as well. So I think that this is what we're really seeing at the moment, is we're seeing the Fed doubling down on being extremely hawkish, and this is why the curve is flattening. It's going to flatten to the point of inversion. And the big conversation is, are we headed into a recession, or is this the Fed actively crafting a soft landing? It's getting a lot harder and harder to imagine that we're going to have a truly soft landing at this pace of tightening.
Is the bond market right now reflecting that view, that it is going to be very difficult to have a soft landing and a hard landing is much more likely?
I would say the short answer is yes, particularly if you look, for example, at euro dollars. An inversion further out in the euro dollar curve implies that the Fed is going to hike to keep inflation expectations anchored, but eventually need to fine-tune policy rates to make sure that any immediate slowdown doesn't start to perpetuate and end up as a true recession. Recall, the Fed was always cognizant that they were trading part of the recovery for price stability. And what we've seen over the last week or so has been an incredible credibility enhancing event for the Fed in terms of being an inflation fighter. And if anything, they've been very successful in communicating that message.
Wait, a credibility booster. This kind of goes against what Mohamed El-Erian was saying, which is that they're actually risking their credibility more. Why is this boosting people's belief in the Fed?
So I think there's two time frames to consider Fed credibility. There's the short term. Do they get it right? Do they get it wrong? Do we end up in a recession or not? Okay, fair enough. This might not be a credibility enhancing event in that context. But if we think about it in a longer term time frame, the last 30 years, the Fed has tried extremely hard to prove that it can contain inflation. And if we think about the increase in Fed transparency, predictability, this is what they have done, and they've made it clear that they can. And what Powell is attempting to do at this moment is say, listen, we might need to go through neutral. We might need to get to 3%, 3.5% potentially in terms of policy rates, but we're going to keep inflation expectations anchored. And that's a really material shift from what we had seen from the Fed over the course of the last several years.
It's important to say it, Ian. I just wonder what kind of price reaction we're seeing in the market. Now, I don't think break-evens are the be-all and end-all, but why are they still elevated if they've reclaimed credibility to fight inflation?
Well, in the near term, the only thing driving break-evens higher, frankly, is food and energy. And a lot of that has to do with the war in Eastern Europe, and a lot of that has to do with the uncertainties that we're going to see play out over the course of the next several months. Five-year forward break-evens, a bit more tame given everything that is going on. Well, I think it'll be very fascinating to see what I expect will be a divergence between headline inflation and core inflation that develops over the course of the next 3 or 4 months. That will put the Fed in a very difficult situation in terms of 50 basis point rate hikes. 25, slow and measured, if you have that divergence, I think will resonate with the market. But if it's all headline and what you're seeing is consumers have their real spending capacity undermined, that's going to be a more persistent problem for the Fed.
Ian, to what extent do you think that Jerome Powell is talking up this hawkish narrative, allowing the market to price reflective of that, to give himself the flexibility to be more hawkish if needed, but ultimately also give himself the leeway to not take it that far?
I think that that is precisely what is occurring at the moment. You're seeing the Fed put the classic trial balloons out there and say, hey, what if we did go 50? Is that going to materially impact risk assets? Are equities going to sell off as a result? And to some extent, one could argue that Powell is asking the market's permission to do 50. And given that financial conditions haven't tightened significantly, equities are holding in, credit seems to be doing fine overall, it seems as though investors are saying, okay, we're content with 50 in May. And that's an important feedback loop, and that's a feedback loop that we've seen many Fed chairs take over the years, and I'm not surprised to see Powell doing it, and I think it makes a lot of sense in this environment.
Do you think the high in the 2-year yield this year, Ian, will be higher than the high in the 10-year yield this year? Can I just get a feel from that for you?
Yeah, so I actually think that the 2s-10s yield curve is going to invert sometime between now and the May FOMC meeting. And I think that the takeaway from that will be a massive concern about recessions, although the Fed will do its best to reframe it as not a recessionary indicator. And I think, as you pointed out earlier in the show, what we're seeing is a convergence of all yields at effectively 225 to 250. And I think that that's going to represent the range of the peak for a lot of the key benchmarks in the Treasury market. The 5-year sector could cheapen even further. 30s, I think, are a real wild card, and the potential for a bounce back in the 10s, 30s curve, a bit more steepening rather than the steady flattening that we've seen, I think will also represent one of the big unknowns.
Ian, thank you. Illingham there of BMO Capital Markets. Just this bunching up at the yield curve in real time, Lisa, to follow it and to see how much the equity market is just shaking it off over the last 3-4 days. It's been interesting to watch.
Yeah, I'm just thinking about what Ian just said. 225 to 250 being the range for almost all of the sectors as we deal with the idea of a Fed that he thinks still has very much the credibility that they can curtail inflation and will raise rates accordingly to get to that level. Just fascinating to see whether people will actually start to come in and buy aggressively at this point.
Well, we're basically there, aren't we? 2s out to 10s from anywhere 216 to 233, basically there.
I do also think about what he's saying, which is a credibility issue. And to me, your question about some of the sort of break-even rates that going forward seem to forecast a higher rate of inflation than what the Fed's rate seems to be, as well as, frankly, bond markets. The commodity story, if it's sticky, how much does it transform the inflation narrative over a longer term, especially as we rejigger some of the entire world of commodities and where the supply chains come from?
On this story, we'll catch up with Jim Bullard of the St. Louis Fed, and we already know what he thinks. He thinks a 50 basis point move. We get some more insight from him with Micah McKee in about 50 minutes' time. Looking forward to doing that. And hearing what Mike's got to say as well. Futures up 1/3 of 1% on the S&P. Yields higher by 4 basis points. Crude not doing much for once. 112 on WTI. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Ukraine's President Volodymyr Zelensky says he's ready to discuss a deal with Russia. He told Ukrainian TV he would discuss a commitment from Ukraine not to seek NATO membership. In return, Zelensky wants a ceasefire, the withdrawal of Russian troops, and a guarantee of Ukraine's security. Germany is backing an international Marshall Plan to rebuild Ukraine after the war. Finance Minister Christian Lindner called for money for reconstruction in a speech to Parliament. The U.S. created the Marshall Plan after World War II to pay for the post-war recovery of 16 nations, including Germany. In Canada, Prime Minister Justin Trudeau reportedly is nearing a deal that would keep his Liberal Party in power until 2025. According to multiple reports, Trudeau's government is discussing an agreement with the left-leaning New Democratic Party. If there is a deal, it would reshape Canada's political landscape. And in Texas, firefighters gain the upper hand over historic wildfires that have blackened tens of thousands of acres. The largest cluster of fires that erupted west of Dallas was 60% contained as of late Monday. Meanwhile, residents of Dallas and Austin had to seek shelter from tornadoes. And Alibaba has ramped up its share buyback to $25 billion. China's e-commerce giant is reacting to staunch a $470 billion loss of value during Beijing's internet crackdown. The government has pledged to support the economy and finish that clampdown on the tech sector as soon as possible. That triggered a historic rally in Chinese stocks. And shares of Nike are higher today. The world's largest athletic wear retailer posted quarterly results that beat expectations. That shows that the company is overcoming struggles with its supply chain and weakness in China. Nike sales beat estimates in all regions. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
not wedded to only moving 25 basis points. I'm not wedded to moving every other meeting. Appropriate policy could at some point be moving nothing. It could be 25, it could be 50, it could be 75, it could be 1. It could be 4. Right? I'm really trying to start blue sky, uncommitted, not locked into anything.
Out of everyone we've heard from at the Federal Reserve over the last week, I have to say that from Atlanta Fed President Raphael Bostic, Lisa, was perhaps the most interesting. Not getting locked into anything for 2022.
And he also talked about using the balance sheet more aggressively and perhaps taking the rate hiking cycle more intact. I mean, honestly, fascinating to see the diverging opinions and how they're going to come to some sort of consensus.
Jim Bullard's ready to go. We'll catch up with the St. Louis Fed President, 8:30 Eastern Time with Mike McKee. Looking forward to that. Futures up 0.25% on the S&P. On the NASDAQ, we advanced there as well, up around about 0.1%. All of the action's been in the bond market over the last couple of days, up another 4 basis points on 10s to 233.33. Lucky to get your chart of the day now. We can do that with Bloomberg's Kriti Gupta. Hey, Kriti.
Hi, John. Well, we have to talk about one of the major stories this morning. A horrific story, of course, is coming from China. The horrific plane crash that you saw, a Boeing 737, not the 737 MAX, but nevertheless the predecessor, crashing in the southwestern province of China. Aside from the humanitarian tragedy, I want to quickly look at the financial implications of Boeing, and that really brings me to my chart of the day. We look at the stock of Boeing in the last 5 years. This was a $400 stock just 5 years ago. It has now halved in just 3 years. Now, a lot of this did, of course, come from the volatility of the 2018 and 2019 plane crashes, but really the bigger hit that you're seeing is coming from the pandemic and, of course, what that means for travel in general. Even after you got the FAA and the EASA, which is the European Aviation Authority, to unground the planes, China still hasn't done that. So one of the big concerns from a financial perspective on Boeing is, does China give the green light to Boeing to really ease some of the pain that it's been feeling? And right now it seems like the stock not really seeing that in its future.
It's a delicate story. Kriti, thank you. And let's build on that delicate story with Bloomberg's Sid Phillip, who covers aerospace and defensive companies for us out of London. Sid, we're still building a picture of what happened here. What do we know so far?
So we don't really know much so far. I mean, investigators are still trying to establish why a 737, which was cruising at cruising altitude, suddenly nosedived from 29,000 feet. And we might get some hints this evening in China local time, when Chinese officials are due to hold a briefing on the crash. So we might get some hints on what really went wrong there.
Sid, what do we know in terms of independent investigators looking at the scene? Is it just Chinese authorities? Does Boeing want some of their own investigators there to parse through the rubble?
So Boeing has offered to help with the investigation, as has the NTSB and the engine makers. So I think at this point it's still pretty early, but I'm sure there are negotiations happening at the moment that will determine how the investigation will be supported. Obviously, the Chinese authorities will lead the investigation, but as in the previous cases with different crashes, other investigators have helped.
Sid, as Kriti mentioned, and it's important to underscore, this was not a 737 MAX. This is a 737-800NG. Can you just talk to us about the safety record of this model of aircraft?
Sure. So the 737-800NG is the predecessor to the MAX. And obviously, it has a very, very high safety record. It's had about 11 fatal accidents in the 25 years that it's been in service. And there's over 7,000 of those planes up in the sky at the moment. So essentially, it is a very, very safe aircraft, and it is among the top safe in terms of safety. And obviously, this isn't the MAX, but at the same time, China Eastern has grounded its entire fleet of 737-800s. And obviously, there are investigations going on as to what happened there.
Well, and obviously China Eastern is not the only airline that operates this model of aircraft. Our team at Bloomberg Intelligence pointing out that airlines like Ryanair have over 200 of these jets that are actually twice as old as the one that crashed in southwestern China, and they make more takeoffs and landings each day. Can we deduce anything from the data, from the safety record of this aircraft, and the likelihood that this was some kind of mechanical or systemic failure of the plane versus error of another kind?
At the moment, it's still pretty early to sort of speculate on what the causes could be. I mean, it is very, very rare for a plane to go from cruising altitude to the ground in less than 2 minutes. So clearly something went catastrophically wrong. And yes, Ryanair and other airlines have these aircraft and they fly them pretty safely every single day. So this would be one of those rare occasions when something went wrong, and I think investigators will be looking to piece together what really happened.
Sid, I know you're hesitant to jump to conclusions, and for good reason, so thank you for shooting straight and for being with us today. Sid Phillip there of Bloomberg, just on the latest on that tragedy of the last 24 hours or so. One stock I want to look at in the pre-market, it is Nike. It's higher by almost 6%, up by 5.8%. Decent quarterly earnings. Jeffrey says it underscores the strength of the brand, and this is the line, Lisa, demand continues to exceed supply. We thought we'd work out of this story at the back half of last year, and here we are, raging through 2022, and it's ongoing.
People still buying, and I will tell you anecdotally, teenagers still love the Jordans, the Air Jordans, and they collect them sometimes on the peripheries.
This is younger Brownvids.
I'm just theoretically, this could happen that teenagers like to buy them. They cost a lot of money, and so there is a constant discussion about how that's not going to happen and the resale market for them. I do think, though, that brand recognition, I'm going to get off from my little soapbox here of personal angst, but there's sort of a bigger point here, which is that they are able to sell their products direct to consumers because you are seeing so much brand recognition, and they're bypassing some of these platforms. I find this really interesting and how much this is actually fueling some of their sales and profits.
And direct to consumer, Kelly Lyons, those numbers were great.
Yeah, and that's an area where Nike has consistently been focusing, less so on the actual presence in physical stores and more on that direct-to-consumer part of the business. And clearly Nike reaping the benefits of that. I just keep coming back to the inventory story, John. A 15% build year on year in inventories, and yet you still don't have the supply to keep up with demand. It raises the question of when these actual bottlenecks, or when the ability of that to become more into balance is actually going to come to the fore. And that's something as well that, as we've had discussions for the last 2 hours on the monetary policy front, when you're looking at inflation to normalize by itself, maybe that's no longer an argument you can make.
Does young Bramo avoid getting the creases in the sneakers? So what does he do? How does he achieve that? What's his strategy?
Really? He walks differently.
Does he?
Then he knows this sort of method of using some sort of towel and an iron, and I'm just sitting
So
here.
he takes the creases out
to take
on
the
the
creases
weekend.
out so that you can remove those. You can use cleaning rags. I'm looking at this and thinking, are you joking me? But they cost a lot of money. He knows I'm not going to buy him another one, and he wants to resell it and then buy another pair. He's found Jordans for me, and I say, no, I'm not going to spend that.
He wanted to buy crypto last summer.
Yeah.
Given the choice again, would you allow him to spend $250 and invest in the market, or go to Nike and buy sneakers?
Really? You're going to do this?
No,
You're trying to make me
in
have
case-
buyer's remorse.
I don't think young Bramo's gone to school yet. I'm just trying to work out if his mother would like to backtrack on the Nike thing and do what I suggested, which was let him invest.
Okay, and fair enough. This is his backdoor way of trying to invest, and he was really into, some of these other cryptos that have done
Summer
really well.
project, just 250.
All right,
Just
okay,
let him have a go.
All right.
If he
I'll do
sells
it.
the sneakers, tell him you'll match him dollar for dollar in the market. If he invests.
He's
and
coming up with my
we
plan.
can track young Bramo's performance through the summer.
Honestly, he
on this show.
would die
And then
go
we'll do a
heaven.
telephone interview. It'll be great.
Oh, yeah. All right, let's do it.
This is Bloomberg.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, Udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame. Sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm still a big believer that the physical global economy continues to motor along.
It really does come down to the consumer. And, real consumption is still very strong.
We are absolutely looking at possibilities of oil prices over $150 this summer.
Where is inflation going to settle? How far is the Fed going to raise rates? And what's the outlook for growth?
There's kind of another inflationary shock that might require more hikes as well from those central banks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is a fascinating moment in global markets from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Lisa Abramowitz and Katie Lyons. I'm Jonathan Ferro. Futures up 0.25% on the S&P. The fascination, Lisa, that belongs in the bond market.
With curves inverting and everything converging around that 225 to 250 basis point kind of range, how much are we pricing in a recession in bonds and looking past it in stocks? How long can that continue?
Well, we're certainly pricing in some front loading now, aren't we? 50 in May and maybe 50 again.
Yeah, and that seems to be more the consensus. Frankly, Fed Chair Jay Powell yesterday, he sounded like he was basically endorsing a 50 basis point rate hike, and he would have to be convinced not to go that much in the May meeting.
President Bullard, 30 minutes away on this program. Katie Lyons with Micah McKee. That one's going to be interesting. We already know what he thinks about the last meeting. What about the meeting still to come?
Right. He's already voted for 50. He was the lone dissenter in the March meeting. But I think what's interesting is the narrative we are hearing from Chairman Powell and really speakers across the board is that maybe there were more that actually are okay with the 50 camp. What stopped them this month was the uncertainty around the war in Ukraine. Is that going to prevent them going forward? I wonder what color Jim Bullard will be able to provide on that.
Looking forward to that conversation, 28 minutes away. I always look forward to your responses on air. Our audience always say it's the smartest out there, the sharpest, and a terminal subscriber said this to me moments ago, Lisa. It always skips a generation. Lisa is always bearish. She was really bad up yesterday, and I nearly went back to bed listening to her at 6 a.m., but her son will probably be buying the most aggressive stuff. Crypto, NFTs, meme stocks, Nikes, and then he said he will be crazy rich too one day.
You know what? He's probably right. He was begging me yesterday. Actually, last year he was begging me to buy an NFT. Yesterday he was talking about certain investments. He's honestly always trying to hustle, and I'm a little nervous.
Conditioned by his very short experience, and he's been right so far.
Yeah, he has been. He wanted to buy Macy's at the heart of the pandemic, and I was just like, "You're 11, no."
We need to get him on the show soon. I've actually had young Bramo on my radio show many years ago, and he made some good calls then too.
Yeah, he loved Apple.
I think he was basically about 6 years old then as well. Futures up 0.25% on the S&P, and the Nasdaq up 0.1%. Yields higher by 5 basis points to 233.87, and in the commodity market, Lisa, 112. If there's some muted price action somewhere, for once it's actually in the commodity market. Crude not doing much this morning.
Yeah, not doing much, but still at 112, which is such a far cry from where we were. I really keep coming back to this idea of Francisco Blanche talking about how 150 on Brent is his base case, and going up to $200 is feasible as things escalate over in Ukraine. I just wonder what that would do to the entire commodity complex. How much would that disrupt stocks, given the fact that so many companies need to absorb those costs, and you're starting to see a little bit of signs that perhaps consumers are pushing back.
For a second, I'd like to make it global just on the central bank story. I've mentioned it a few times. We haven't gone really in depth on this story, not once over the last few hours. Dollar yen. Kenny Lyons, you have been on top of that, just bringing together Asia and what's happening here in the States. Dollar yen, 120 and pushing 121.
This is a level we haven't seen in more than 6 years, John, since going back to the beginning of February of 2016. What's so interesting is that you're seeing this divergence between the Fed, the BOE, even the ECB sounding more hawkish, and the Bank of Japan, where Kuroda is saying, even if everyone else is doing it, we don't have to. He sees absolutely no reason to hike interest rates at this point, even as they are potentially looking at 2% inflation as soon as next month.
The main story for us, it's in the yield curve. 530 is the lowest since 2007. If you compare 2s and 10s, the lowest since March 2020. The spread between the two getting tighter. This curve is getting flatter, and pockets of it inverting. Joining us now is Patrick Armstrong, Chief Investment Officer at Plurimi Wealth. Patrick, let's start here and work through it together. Are you comfortable being long, say, the S&P 500 as this yield curve inversion starts to develop?
I think you can do better than the S&P 500. I'm comfortable to be long equities. I don't think this is the time to be passive. We've got a clear change in the macro environment where we've gone from a Goldilocks environment where everything was ticking along great, but inflation wasn't provoking the Fed. Now we're in an environment where we've got growth slowing and the Fed is moving from steadily to expeditiously hiking rates. So that's the code for 50 basis points at the next meeting, and maybe 50 basis points for the next few meetings even. So I'm not averse to owning equities. I want to own equities, though, that are priced cheaply and not long duration. So I want to be short the big cap tech companies that still have no earnings, no real path to profitability. I want to own materials companies. I want to own energy companies. We're in an environment now where governments and companies are going to be building strategic inventories so they don't have the supply shortages. So Europe's going to need energy, not just from Russia. If you're a producer of any kind of good, you have semiconductors, and you've been hurt by the semiconductor shortages. You're not just going to do just-in-time inventory. You're going to probably build a hoard of semiconductors or chips so you can produce your goods. And all of those things don't mean buy passively. You want to buy the companies that own resources that are in high demand and are scarce. So I'd rather not own the S&P. I'd rather pick equities within the S&P.
Patrick, what are your economic parameters to stock picking? Is it that we're going to avoid recession in the next couple of years? Is it that perhaps that risk gets more intense later on?
I think Europe's probably going to fall into a recession, just given what's happening in Russia and the reliance on Russian energy. I do think as Russia continues its assault on Ukraine, Europe's going to move away from Russian oil and gas, natural gas even, and that's going to have a very strong recessionary force, stagflationary force. I think that impact's not as big on the United States, which is much more energy independent. So I think the U.S. should be able to flirt with a recession and not fall into it. I think Europe probably falls into it. But whenever you have a Fed hiking cycle, whenever you have a 210 that's almost inverted, those have been very good indicators of looming recession. So if Powell is as hawkish as he's trying to make us believe he will be, a recession isn't far-fetched anyway. I don't think we fall into it in the U.S., but it's definitely not a far-fetched idea either.
Well, Patrick, you mentioned curves, at least on the 210 nearing inversion, and other parts of the curve you already are inverted. Yet the equity market, by and large, has seemed to look through that in recent days. And I'm wondering if that is the idea that bonds are going to fare worse off in an aggressive Fed tightening environment than equities, or is there a point where you actually have bonds selling off to the extent that they then become attractive because they have a higher yield, and then TINA is called into question?
Yeah, you've still got negative real yields on 10 years, so the 10 years yielding about 2.3%. Inflation expectations are still 2.8%, I think, 10 years out right now. So that's the highest in the last 30 years, inflation expectations over the coming decades. So bonds aren't attractive. You buy a treasury, if you hold it to maturity, you're losing purchasing power. Equities still give you the hope of growing purchasing power by putting your capital at risk. And I just think it's a clear tailwind for the lowly priced equities, and it's going to be an environment where you want to be short duration. You want to be short treasuries because those yields are going to grind higher, and you want to be short the equities that are still trading at ridiculous multiples, even though these companies have fallen 50%.
Patrick, where does this leave the trade in Europe? You know, a number of weeks ago, I think we're all thinking the same thing. The Europe trade's dead now. Recession unavoidable. People have been piling into the European banks. The ECB will have to back away. Then we erased all the losses since the invasion on the stock 600, and I think people taking a second look. Price action does that to you, and wondering whether maybe those banks can perform again. Patrick, your thoughts on that?
I wouldn't be buying European banks right now. You've got an ECB that's stuck at negative interest rates. You've got a looming recession in Europe. There's no backdrop that creates consolidation, which would be a real boost for the banking sector. So incredibly cheap on tangible value, but the profit model is destroyed given what central bank policy is and given what the coming economic environment is going to be.
And it's going to be tough, that's for sure. Patrick Armstrong of Plurimi Wealth. Patrick, thank you. Lisa, the conversation for the last 10 years, value gap or value trap? And I think you heard it there from Patrick. Value trap.
Value trap, and yet when he talked about cheap, what's cheap? He said energy companies are cheap. And this comes after a nearly 40% rally year to date. And given the fact that we've seen that huge commodity rally in general, the fact that he still thinks that they're cheap gives you a sense of how difficult it is to really pick your spots in a fast-moving market where the parameters seem to be shifting by the day.
We caught up with Francisco Blanch about an hour ago from Bank of America. Did not bank away from that call for 150 on crude. Heard the same thing from Amrita Sen of Energy Aspects. We've backed away from it big time in the market. They haven't backed away from their call for the end of this year.
Yeah, and frankly, they attributed what happened last week to this idea of people actually pulling back some of their derivative exposure because of collateral calls, that they had to post more collateral. So that this lack of liquidity is actually leading to prices being lower than where they were otherwise as they start to game out what a prolonged conflict would look like.
Would you like some of the Twitter feedback for young Bramo? Would you like me to share that? I'll share that now.
You will. So
I can't believe you actually wore her down. That was from Hyperconvexity. I've been pushing this for a while to allow young Bramo to invest.
All right, okay, I will.
I think we'd all be happy for the young Bramo index to replace the Dow. I'm with you. I'd be happy to quote that.
Not
Someone
me.
else, Jesse said, I hope young Bramo buys Bitcoin and only Bitcoin and nothing else. Would you like that concentrated portfolio in the Bramo household?
He went through a period where he was into that, and then he was thinking about some others because of what is backing NFTs, and he was doing research. Let me tell you, staying at home without a lot to do during the pandemic yielded some
Did you ever hear the
dangerous
story about
results.
Stan Druckenmiller? It's an old story. He told it years ago. It goes something like this, that when he first got his big job investing, it's because the older guys knew that he was too young and too dumb, which meant that he would be willing to be long. And the older guys were too scarred, too smart and too scarred to participate in the upcoming bull market. I always found that fascinating.
I love that. And I should have listened to Zeke when he said, Ethereum, buy Ethereum.
Listen to the kids when it comes to markets. Sometimes.
Sometimes.
That's not investment advice. Sometimes. Speak to your financial advisor. Futures up 0.25% on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Ukraine's President Volodymyr Zelensky has called on Pope Francis to mediate in the war with Russia. In a tweet, Zelensky says he told the Pope about the difficult humanitarian situation and the blocking of rescue corridors by Russian troops. Meanwhile, the Kremlin once again said that peace talks are going more slowly and less substantively than it would like. Ukraine accuses Russia of negotiating in bad faith. President Joe Biden is warning the private sector, improve your defenses against cyber attacks immediately. The president says the Kremlin may be plotting cyber attacks to retaliate for sanctions imposed for the invasion of Ukraine. The White House provided few details about the nature of the threat. Federal Reserve Chair Jerome Powell is now using a more aggressive tone towards curbing inflation than he did just a few days ago. Powell says the Fed is prepared to raise interest rates by a half percentage point at its next meeting if needed. Last week, policymakers increased the benchmark lending rate by a quarter point. Investigators are trying to figure out why a China Eastern Airlines Boeing 737-800 suddenly fell from the sky. The crash in the southwestern part of the country is believed to have killed all 132 people on board. Air crash experts are baffled by the plane's nosedive from 29,000 feet. Meanwhile, China Eastern grounded its fleet of the planes. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people.
The only way out is through diplomatic means, it's through dialogue, and that's the only way we can stabilize our continent and our region. We all know that the situation could evolve down very negative scenarios. We're aware of it. I think what happens now is already much worse than most people in Europe expected.
Nico Popescu there, the Foreign Affairs Minister for Moldova, from New York City this morning. Good morning. Futures positive about 9 points. We faded a little bit. We're up 0.2%. The Nasdaq essentially unchanged. Bond yields higher by now 6 basis points on 10s to 235. All that bond market action, Lisa, continues to build.
What's interesting is we saw people saying that when yields got to this level, that it would disrupt equities. This was the threshold where we would see some sort of market turbulence. Well, we had market turbulence. Is this what we call market turbulence? Are we seeing that right now in equities?
Is it building? Is it building? TK's missing out today. Can we say that? Do you agree?
Yeah.
Tom Keen's missing out in a major way. When this invasion started a month ago, Tom wanted one person on the show. And it's our next guest, and Tom's not here. And if Tom was here, the introduction for our next guest would be about 30 minutes long for good reason. Angela Stent joins us now, the non-resident senior fellow at the Brookings Institution and the author of Putin's World, Russia Against the West and With the Rest. Angela, let's start here. There is this Western-centric conversation that there is some instability building in the Russian government, that we could have regime change, that Putin could fall. Can you give me your line of thinking on what's happening within Russia?
Yes, I think many of us are clutching at straws and there's wishful thinking here. I mean, what do we know? There are some rumors that some high-level intelligence people have either been arrested or fired and blamed for, obviously, the failure of intelligence at the beginning of that war. But these are just snippets. We know that there have been demonstrations against the war, that thousands of people, I think at least 10,000 people, have been arrested. They can face up to 15 years in prison for their protests. We know that 200,000 Russians approximately have left since the beginning of the war, and they've gone to Europe, other parts of the former Soviet Union. But we really don't have any proof that in Putin's inner circle, there is any plot afoot. And it really would have to be his inner circle. He's very much in a bubble. He doesn't see very many people. Yes, some of the oligarchs have obviously complained about what's happened to them, and they've lost their yachts and their homes. We know that. And we heard rumors that the head of the central bank, Elvira Nabiullina, wanted to resign, but she's still in her post. So I think we have to be very cautious about assuming that a palace coup is underway. At the moment, Putin appears to be firmly in the saddle. He's obviously isolated. He's lashing out verbally, as we saw. But when we saw this big rally last Friday that he had in the stadium there, celebrating the anniversary of the annexation of Crimea, he seemed to be very much in charge.
Angela, when it comes to lashing out, how much are we going to see an escalation in the types of weapons used, in some of the methodologies that Putin opts for, in light of just what you talk about, the fact that he is cornered and isolated?
Well, we're seeing, obviously, the bombardment of cities. We're seeing a humanitarian catastrophe. There is, our government is warning that the Russians may use chemical weapons. They've been warning that for at least, I think, a week. And of course, Putin has made veiled hints about the potential use of nuclear weapons or a tactical nuclear weapon. So I think we do have to watch out. If you go back to the Syrian playbook, the way that the Russians behaved there with the indiscriminate bombing, the razing to the ground of the city of Aleppo, and the use of some chemical weapons, we do have to watch out for that. And that, of course, is a major concern going forward.
Angela, it's been suggested by the Biden administration as well as others that Putin's ultimate ambition does not end with Ukraine. What he would really like to see is a return to the Soviet Union in some sense. If that is true, what does that mean about the likelihood of a lasting peace agreement, or at the very least, an agreement at all?
So you might get an agreement to end this war eventually. We know, it would clearly involve Ukrainian neutrality. The question is, what about Crimea and the Donbass, the southeastern Ukraine region? That's a possibility. We're not nearly there yet. But beyond that, if the Russians manage somehow to prevail, yes, Putin's ambitions go beyond Ukraine. He's talked about a new Slavic Union state comprised of Russia, Belarus, and Ukraine. That's a possibility. But he's also hinted that Russia has its sights even further west, that it wants to reestablish a sphere of influence, not only in the post-Soviet space, but maybe in Central and Eastern Europe too. So I think the likelihood of a lasting peace agreement, this is really quite far off. And we'd have to have all the parties sitting down, as Mr. Popescu said, and rethinking Euro-Atlantic security going forward. And that's a major task.
Angela, that title of your book, Putin's World, Russia Against the West with the Rest. Can we talk about the rest? When we think about the rest now, increasingly we just think about China. And I wonder if the rest wants to be with Putin for much longer here. Do you think, A, that China will back away from its relationship with Russia because of developments on the ground? And B, do you actually believe that Vladimir Putin would listen to Xi Jinping if President Xi tried to intervene?
I don't think China's going to back away from its relationship with Russia. I think China's in a difficult position because obviously Putin wouldn't have gone ahead and done this had he not thought that he had Chinese support. But Xi Jinping has cultivated this relationship with Vladimir Putin. I mean, it's a mutual cultivation. And they see each other both as authoritarian leaders determined to push back against a world order that was imposed by the United States and its allies. So I think we should not expect China to back away from backing Russia. But of course, Chinese major banks now are apparently complying with some of the sanctions. It'll be tricky for the Chinese to avoid having a major economic problem with the West because of the sanctions. But I think they will remain backers of Russia, even though they repeat that they believe in the territorial integrity and sovereignty of Ukraine. India is another country to watch. The Indians have not criticized the Russians. They're not going along with the sanctions. They have their own issues with China. They have a huge arms relationship with Russia. And then you have African countries, South Africa. You have countries in the Middle East, in Latin America. So we have to remember that the West is united in its condemnation of Russia and its horror about this war. But much of the rest of the world isn't, because it also has a much more skeptical view of the United States.
Angela, we are so lucky to catch up with you today. Come back soon, please. Angela Stent there of the Brookings Institution and, of course, Lisa, well-known author.
Yeah, honestly, that's such a good point that she made at the end, that the rest of the world, other than the West, is rather ambiguous about the U.S. leadership, especially after the past decade, where you saw a bunch of wobbles.
Putin isn't just with the rest seems to be with Putin, for now at least. Futures up 0.2% on the S&P. Coming up, Jim Bullard of the St. Louis Fed with Bloomberg's Micah McKee, a conversation you do not want to miss. That's next.
estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Sydney.
In San Francisco.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Live from New York City on TV and radio, here's the price action. Futures up 0.2, the Nasdaq unchanged, the S&P 500 up by 0.21% at the moment. Yields are higher by 5 basis points to 234. There is tons to talk about in the bond market. Let's start with the curve. The curve just a bit flatter over the last few weeks. 18 basis points, the difference between 2s and 10s. If you compare the 3-year, the 5-year, the 7-year to the 10-year right now, 3s, 5s, 7s, all trading above the 10-year yield. That curve, pockets of it starting to invert. The perfect conversation now. Mike McKee, as always, one of the best in the world, the best at following this Fed, sitting down with the St. Louis Fed President, Jim Bullard. Mike, good morning to you, buddy.
Good morning to you, John, and good morning to you, Jim Bullard. Thank you for joining us on Bloomberg Radio and TV.
Thank you. Thanks for coming out to our new museum here.
Yeah, this is the Money Museum. It's fascinating, and if you're in St. Louis, you should come visit it. We're sitting right next to the sign that talks about hyperinflation, so it's sort of a perfect spot for us here this morning. A week ago, you were the lonely dissenter looking for a 50 basis point rate increase. Now, the chair has all but promised a 50 basis point increase. At least that's the way the markets are taking it at the May meeting. What happened in the last week?
I think, I mean, those that are interested can read my dissent statement, which is out last Friday and is on our webpage. I think the Fed needs to move aggressively to keep inflation under control. Our policy, as we sit here today, is still a very large balance sheet and very, very low policy rate. We need to get to neutral at least so that we're not putting upward pressure on inflation during this period when we have much higher inflation than we're used to in the U.S. economy.
Well, when you say we have to get to neutral, how quickly? You have been arguing for more than 200 basis points.
Yeah, I think faster is better, and I think the 1994 tightening cycle or removal of accommodation cycle is probably the best analogy here. That one was quite successful. The Fed moved 300 basis points in a single year, and then made some adjustments afterwards in 1995. The result was that we hit our 2% inflation target over the next 10 years. The economy boomed in the second half of the 1990s. So I think this is a situation that's like that. We came out of the pandemic, you got surprised by inflation, but now what you have to do is move the policy rate up discreetly, a fair amount, not to be too disruptive, but I think 50 basis point moves would definitely be in the mix. And then get to a level that we can be neutral, and then from there we can decide if we want to be restrictive and put further downward pressure on inflation. But right now we're putting upward pressure on inflation. It's the wrong place to be given where inflation is.
Well, as I noted, the markets, whether you look at swaps or futures, are now pricing in 50 for May 4th. The Fed doesn't like to surprise the markets. Should we assume that that's what you're going to do?
Well, I can't. I'm just one person on the committee. I don't know where the rest of the committee will be, and the chair has to manage that process. I thought that was a good speech yesterday that laid out the situation, and we'll see where we are when we get to May 4th.
Now, the economic data have been closely watched, but from what you're saying, it doesn't sound like it really matters between now and May, that we're too low in terms of the Fed funds rate and inflation is too high, and those are the only two considerations.
Well, that's the big picture, and I think that's right, that we don't really need a lot of more data here, but you never know in this world and in this business. You can always get surprised. Obviously, we've got geopolitical risk out there. I guess my feeling on that is that, we can't wait for that to get resolved. This could go on for a very long time, and certainly geopolitical tensions, even if the war ended tomorrow, the tensions would last for a long time. So I think the best contribution we can make is to get our house in order and make sure that the U.S. economy is doing as well as we can achieve, and that will be the best that we can do to contribute to the global situation.
Without going all R-star on everybody, the idea of neutral is a moving target. Different people think of different levels. One analyst summed up your policy right now as the Fed is going to keep hiking until something breaks. Is that the best way to think about it?
No, that's not a good way to think about it. We're going to go to neutral, which is the place where we're not putting upward pressure on inflation. You don't want to put upward pressure on inflation when you've got headline CPI, close to 8% here, and probably more to come in the inflation reports ahead. So we want to get to neutral so that we're not putting upward pressure, and probably get to a restrictive policy so we're putting some downward pressure. History tells us that the faster we move to that situation, the better chance we'll have of moving inflation back to target and getting a boom in the U.S. economy to boot.
What's neutral to you?
On the funds rate, I've got 2%. That's because my R-star is lower than others. I'm willing to go with a 0 R-star, so that's lower than other estimates that are out there. So I'd be 200 basis points on the funds rate, but I'd want to go to 300 this year to get mildly restrictive, and then that'll help us turn inflation around, and hopefully we'll also get some moderation in inflation from other sources.
What you worry about is inflation psychology getting embedded in the economy. What are people in your district, CEOs, telling you about shortages, supply chain problems, and about what they're able to charge, pricing power?
Well, most disturbingly, they're telling me that pricing power is not a problem, that they're able to raise prices and pass on the higher costs to their customers. So that's exactly the kind of situation that you don't want. You want them to be more worried about losing market share when they raise prices. And so for that dynamic has been worrisome to me, and that's something I think we need to get under control. I think a discrete adjustment to the policy rate would help break the inflation psychology and help keep inflation under control in that sense. They're also saying a great deal about supply chain issues and how those are going to continue, and they will probably not get resolved anytime soon. We may have to wait out into 2023. That's way too long for this policy process, so I don't think we can just wait for that to happen.
What about the balance sheet? What's your best guess as to the best course for reducing the balance sheet, and what effect would it have on interest rates?
Yeah, I said in my dissent statement that I'd be happy to just get started on the balance sheet runoff now. I think we overstayed our welcome on purchases. You know, it's always hard to make these judgments, but in retrospect, looks like we allowed the balance sheet expansion to go on too long. So I'm be happy with sooner is better. I would have been happy to do it at this meeting, this previous meeting last week. I see no reason to not just get going on that process. We've got a long ways to go on that dimension as well. The balance sheet approaching $9 trillion. You know, pre-pandemic it was $4 trillion. So you've got a lot of balance sheet reduction that can go on. It would be passive runoff.
Before we let you go, how would you advise people to look at the summary of economic projections and make sense of it, given that it says interest rates are going to rise to be restrictive and inflation's going to just drop off over the next 3 years, but unemployment's not going to move at all?
Well, the real economy is doing very well. The U.S. economy, even with geopolitical risk, is expected to grow at above trend pace this year, next year, even the year after that in a lot of forecasts. So that's going to continue to put downward pressure on the unemployment rate and continue to have an even stronger labor market. If you look at the Kansas City Fed's Labor Market Conditions Index, it's almost at an all-time high here. It probably is going to go to an all-time high. So one of the best labor markets in a generation. So I just think that you know, the real side of the economy with continued reopening following as the pandemic continues to fade here. I think there's a lot of reasons to think that we'll have a robust economy going forward, and that suggests robust labor markets going forward. So what we'd have to do is adjust the policy rate discreetly, get to the right level, then we can make adjustments from there.
And you can get a soft landing?
I think so.
Jim Bullard.
We did in 1984. We're going to do it again.
Jim Bullard, president of the St. Louis Fed, thank you very much for joining us this morning. I'll send it back to you.
Mike McKee, the Money Museum, is it nice there?
Very nice, but I don't think they're giving out free samples.
They're not. That's what I just inquiring minds want to know. Mike McKee, thank you. Great interview, buddy. As you might expect from Mike McKee with the St. Louis Fed president, Jim Bullard. Mike McKee actually tweeted out the picture of the hyperinflation poster in the Money Museum. And for anyone wondering about hyperinflation, because I know I get a lot of messages about it and I always push back, here's a definition of hyperinflation at the St. Louis Fed. When inflation, the general sustained upward movement of prices for goods and services in an economy reaches more than 40% per month, it's known as hyperinflation. Then they have a list of countries with the worst hyperinflation in history: Germany, Greece, Hungary, China, Serbia, Zimbabwe, as you might expect. 40% a month, according to the St. Louis Fed, Lisa.
Really, that was the first thing that you thought of when you thought of the Money Museum, was whether they were giving out samples?
No,
or you could go there and collect some money?
Let me clarify. At the Central Bank of Austria in Vienna, you can go in and you can lift up a bar of gold. They have a bar of gold in the entrance around the corner. I'm not giving anything away. You can go in and see it for yourselves. I'm just wondering what the experience is like at the Money Museum. That's all. Should we go through these comments from
I think that, yes, let's
Jim
do
Bullard?
this.
Let's start with faster is better.
Yeah.
Faster is better. I think 50 basis point moves should definitely be in the mix. Right now, we're putting upward pressure on inflation. It's the wrong place to be. And he's talking about getting things up to a restrictive stance, 3% by year end.
And he was saying that they don't need a lot of new data to make these faster than expected moves. Also, I thought it was really interesting that he said he was concerned that businesses are able to pass along the cost to consumers, that there isn't pushback, and that has him very concerned about an unmooring of inflation expectations.
And the hope is there. 1994 and a soft landing.
Yeah.
Is that enough for you?
Yeah.
9:30, Mohamed Al-Aaron has something to say. We'll catch up with him in 50 minutes' time on Bloomberg TV. Looking forward to it. Kaylee, thanks for being with us again. I know you'll be with us again tomorrow. TK and his extended vacation continues with Lisa Bramett and Jonathan Ferro. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. A Russian court has sentenced jailed opposition leader Alexei Navalny to 9 years in prison on fraud charges. Navalny is Vladimir Putin's top critic. He's been detained for more than a year since he returned to Russia following a near-fatal heart attack involving a nerve agent. Navalny and Western governments blame that on Putin's secret services. Senators will question Ketanji Brown Jackson on day 2 of her Supreme Court confirmation hearings. Republicans intend to ask her about her sentences in child pornography cases and her work as a public defender. If confirmed, Jackson would be the first black woman on the Supreme Court. Germany is backing an international Marshall Plan to rebuild Ukraine after the war. Finance Minister Christian Lindner called for money for reconstruction in a speech to Parliament. The U.S. created the Marshall Plan after World War II to pay for the post-war recovery of 16 nations, including Germany. In Canada, Prime Minister Justin Trudeau reportedly is nearing a deal that would keep his Liberal Party in power until 2025. According to multiple reports, Trudeau's government is discussing an agreement with the left-leaning New Democratic Party. If there is a deal, it would reshape Canada's political landscape. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Is this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, you know, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the Angstrom era when we're going to 2 nanometers and below into the Angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I think we're at a very, very, very volatile inflection point. It will come down to whether or not the Russians will be satisfied by simply extending their effective borders in the Ukraine. Will they take Kiev? Will they position themselves to reach beyond the borders of the Ukraine? The last is terrifying to markets.
Terrifying not just to markets, but to the world at large. That was Ken Griffin, Citadel founder and chief executive officer. You can watch the full interview. That is coming up at 9 p.m. tonight. Bloomberg Wealth with David Rubenstein. And David Rubenstein, we are so lucky, is here with us as markets grapple with the conflict in Ukraine. A big question has been why things have been so sanguine, if incredibly volatile. What was Ken's response to just this incredible willingness to look past some of the conflict and continue to buy?
Well, Ken has built one of the greatest hedge funds in our country's history, and also now has built a great trading operation, Citadel Securities. And in those kind of situations, you have to know what the geopolitical forces are going to be and what they're likely to do in terms of their impact on the markets. So he has a team of people that are looking at this situation, but nobody really knows right now exactly what's going to happen. But he's obviously worried about it because it'll impact markets and affect his trading, and it also affect his Citadel Securities business. Ken has had more impact than almost any major financial person on the markets in the last number of years, because Citadel Securities has become one of the biggest market makers in the country. And also his hedge fund has done spectacularly well, probably the second most profitable hedge fund in our country's history.
And this has caught a lot of people's attention, especially as he consolidates a lot of equity trading volumes within the Citadel Securities unit. How much do you talk about the need to keep a wall between these businesses, to keep them separate in both perception and actuality?
Well, he does keep them separate because there are obviously potential conflicts, but he's obviously had it walled off, and he has separate teams of people. They are owned by about 50 people. His hedge fund is owned by about 50 people, including himself, and his Citadel Securities is owned by about 50 people, including himself. He's obviously the largest shareholder in each. But he also recently sold, for Citadel Securities, he sold a piece of it, 5%, to Sequoia Securities, or to Sequoia, I should say, venture fund, and also to a Paradigm, which is a crypto company. And he kind of hinted in the interview that now they'll probably begin in the not too distant future to make markets on crypto currencies, which he hadn't done before. He's been a skeptic of crypto, and now he says he's less skeptical.
Well, David, what caused that change of heart?
Well, when markets move a certain way and you're a force of the markets, you recognize the markets are saying something that you didn't recognize was the case earlier. So he's now been a skeptic of crypto since its beginning, but now he's kind of said the market has $2 trillion of value in cryptocurrencies. So if you're going to be a player in making markets for people, you can't afford to not be in that crypto market.
So what opportunities does that create for him and for Citadel more broadly?
Well, crypto now has a gigantic following among people, and I think it's going to get bigger, and this is one of the reasons. What we've learned recently is that the governments can take away your assets pretty quickly. Now, everybody's not a Russian oligarch, but these Russian oligarchs thought they had all their money hidden in various places, or they could get anytime they wanted, and so did the Russian government. Russian government thought they could get its assets anytime. Now, we can see that governments can freeze and confiscate your assets. So many people are looking at this around the world and saying, wait a second, maybe I need to have some assets that the government can't get to, or they're hidden, or they're anonymous. And I suspect you'll see a lot of people in China and other places where they want to hide wealth buying more and more cryptocurrency. So I think it's going to be a big growth business.
It's one of the really important points that will be discussed. It is at 9 p.m. tonight. I look forward to looking at the full interview, David. But before we let you go, I do want to shift gears a little bit. We've been hearing from Fed officials. We heard from Fed Chair Jay Powell yesterday. Today, this morning, just moments ago, Jim Bullard of the St. Louis Fed coming out saying that he does think that we can achieve a soft landing, even as the Fed moves to a more restrictive policy. Based on the on-the-ground experience that you have with the firms you're investing in, do you think that it is achievable?
Well, nobody really knows, but I think the Fed has done a reasonably good job of recognizing now that interest rates probably need to go up, and the question is how much and how frequently. And I think the markets are now assuming about six different times this year we'll probably have rate increases, probably of 25 basis points each time, but it's not impossible. There could be a 50 basis point increase at some point, depending on what the inflation numbers are. I do think the Fed has probably said it may have missed the market a little bit, and maybe it could have been a little bit earlier and maybe a little bit stronger in fighting inflation. I think the word transitory is one that's now probably not going to be used again.
Well, and of course, they stuck to that for quite some time. How much credibility do you think the Fed has lost or still has here?
The Fed has enormous credibility around the world because of what the Fed is, but the Fed, is not perfect, and maybe they would say in hindsight, or when the memoirs are written by people, they will say, well, maybe they could have acted a little bit sooner, but I don't think it's a gigantic problem, and then now we're on the right path, so I think it's okay.
That's at 9 p.m. David Rubenstein, we all look forward to watching every week. Thank you so much for being with us. That is Bloomberg Wealth with David Rubenstein tonight at 9 p.m. New York time, 7 p.m. Hong Kong. That would be on Wednesday, and 6 p.m. Wednesday in London. I got to say, Kaylee, I keep going back to some of the comments by Jim Bullard just moments ago, this idea of how fast the Fed has to go to stop actually juicing inflation, being upward pressure on inflation, not necessarily suppressing it.
Yeah, to Jim Bullard, it's not just about getting to neutral, which he sees as 2%. He wants to go to 300 basis points on the Fed funds rate to get restrictive and start to tamp inflation down. And I thought was one of the most interesting things he said is he thinks 50 basis point moves plural, will be in the mix. And that echoes the likes that we've heard from the likes of Jan Hatzius over at Goldman Sachs, who's calling for 50 in May and also in June.
All right, so I have a reputation of looking at the negative very frequently, and again, it is just genetically predisposed. But I will say there is a question of how far the Fed can go before it curtails some of the dynamism in the market. You do a great job of looking at all of the companies as they come out with their earnings, and honestly, they have been robust for the most part. Nike, yes, a strong story in and of its own right, but each one shows that, yes, businesses, just like Jim Bullard said, have been able to pass the costs on to consumers and hasn't really shown signs of letting up. So, on the flip side, that's what's giving people some confidence to go into equities.
Right, that pricing power and the ability to retain margin, capture that profitability, even in an inflationary environment, in theory is a good thing for investors that have money at stake in these companies. Less so a good thing for the Federal Reserve, though. Jim Bullard says that pricing power, the ability to do that, is actually something that concerns him. So what's good for the Fed may not be what's good for equity investors and vice versa. I think what's also really interesting, and this goes to the point Mohamed El-Arian raised in his Bloomberg opinion column this morning, and I'm sure he'll raise with John coming up in the next hour, this idea that the Fed is kind of faced with two decisions here. You either act to tame inflation, knowing it ultimately could cause a recession, or you don't, and you let inflation run hot. Which of those scenarios is better for the equity market?
And actually, Ian Lingen was saying that the market would be more disturbed if the Fed allowed that longer-term rate to get unmoored, that actually what we're seeing in markets with this flattening yield curve is confidence in the Fed and faith that they can actually slow inflation over the longer term. Right now, you are seeing that lift continue. The S&P up 0.3% ahead of the open, 44.66. The euro a little bit higher against the dollar, a little bit of a reprieve after the dollar strengthening, and 10-year yield a little off the highs, 2.33%. Coming up, we have much more. Don't miss it. This is Bloomberg.
energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Wherever you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Your equity market staring down a flatter yield curve and doing okay for now. Equity futures up 1/3%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue, pricing in a quicker Fed.
They are certainly in the mode to raise rates right now.
Getting there a little faster.
It's possible that the cycle is faster and hotter.
The market can handle it. What Chair Powell told us all today was that's exactly the sort of thing that should be on the table. Would we do 50 if it was up to us?
Powell has joked about raising rates 50 basis points.
They are on a path to continue raising rates.
That puts a lot of pressure on markets.
You look at the 2-year, the 5-year, they've all priced in the tightening.
The market starts to see, yes, we'll have a very aggressive path to interest rates over the next year, but it seems to be short-lived.
The Fed is very much still intellectually dovish, but cyclically hawkish.
We have a quite unpleasant situation for markets currently.
But clearly, 50 basis point hikes are on the table.
Let's get to the panel. BlackRock's Wei Li, AllianceBernstein's Gershon Distenfeld, and Eric Nelson of Wells Fargo. Wei Li, first to you. You do not believe the Fed can deliver an aggressive path. Why?
Well, we think that getting faster to neutral is fair enough because the restart of the economy does not need additional stimulus. But we do not think that it can carry through the entirety of the tightening that it has signaled, because if you think about what it has forecasted in its economic projection, it doesn't think that the tightening is going to have any meaningful impact on unemployment, which signals to us that they are actually just talking tough, because additional tightening beyond neutral is going to come at a cost of, well, heavy cost to the labor market, to the economy. And talking tough right now does not, it's not costly. They can do that, right? And if you think about kind of the flatness of the curve and also parts of the curve inverting, 5-10 inverting, it goes to show that actually, whilst we don't believe that they would carry through the entirety of the tightening, risks of policy error by way of over-tightening has risen. A risk of slamming the brakes has risen, which is why we continue to reiterate our underweight in U.S. government bonds, and against that, pair that with the overweight in developed market equities.
Gershon, your view on this as well, please. Do you think the economy can take this, the plan the Fed has?
Well, the question is, what is really the plan? Like, remember, John, 4 months ago, if you look at the dot plot, the most hawkish dot is today the most dovish dot. So things can change very, very quickly. And what the Fed is saying is that they actually don't know. You know, the whole market is used to the Fed, you know, not withdrawing the what's it called, the punch from the punch bowl. I messed up that saying. But what Chair Powell has been saying is that we're not afraid to do 50 basis points. We're not afraid to be aggressive. And I think that we have to recognize that it's not only a matter of tightening financial conditions, which the Fed is going to try and do to slow down inflation, but also the supply chain issues hopefully are going to be worked out. We don't know the kind of balance between those two. And depending on where inflation is later in the year, we're going to see the Fed either keep on going or start to really moderate. What's very unusual about this, the future pricing, you look at the euro-dollar curves, for 2024, it's pricing in cuts. We've never seen that before at the start of a tightening cycle.
We've only had one hike. Goldman says there's more to come, 50 basis points at both the May and the June meetings. Eric, I want to come to you. Out of all the contradictions in the summary of economic projections, one thing stands out for you. You think the end peak rate for Fed funds is going to be much higher than some people believe. Why is that, Eric?
Well, John, if you look back at the last couple tightening cycles, what stands out is the real Fed funds rate ends up in positive territory. So even if you have the assumption that inflation settles back down to, let's say, 3% for argument's sake, you're still looking at a nominal Fed funds rate that has to go above 3. That's pretty far off from the Fed's projection around 2.4. So we think there's more upside for terminal rate pricing. And we think the one area where markets, I think, are really getting this wrong is that the Fed can deliver on its plan of tightening pretty aggressively and probably can get that terminal rate above 3%, which means more upside for both front end and long end U.S. yields.
Well, Jim Bullard of the St. Louis Fed would like to be above 3% this year, not next year, not the year after, by year end. He said faster is better. Take a listen.
Faster is better. I think 50 basis point moves would definitely be in the mix. Right now, we're putting upward pressure on inflation. It's the wrong place to be, given where inflation is.
It's the wrong place to be, Mike McKee. Your take on that interview, and great interview, by the way, from 30 minutes ago.
Well, John, I think that we all knew Jim Bullard was going to be aggressive. He wanted 50 basis points before the last meeting, and now he says with what Chairman Powell laid out yesterday that 50 basis points for several meetings in a row is a live possibility, and he'd support that because, as you mentioned, he is the dot that is the highest on the left-hand side of the dot plot for 2022, 300 basis points. And what he said was really interesting. That he thinks we should go up by 300 basis points, but neutral is only 200. So he thinks the Fed needs to get restrictive for a while by about a percentage point in the next couple months to be able to cut off inflation. Then it can come back down. The fact that he thinks that neutral would be about 2% is interesting because that would take most of the inflationary pressure out of the economy if the Fed got that high and bring us back to the sort of status quo before the pandemic.
Soft landing. He's talking about a soft landing, Mike. Mohammed's writing this morning, and I'll catch up with Mohammed Al-Erin a little bit later this hour. He said the central bank appears to have a choice between risking a recession or prolonging inflation. I didn't get the sense from Jim Bullard, Mike, an hour ago that that was his take.
No, he seems to think the economy is going to be strong enough. I asked him how we make sense of the summary of economic projections that calls for inflation to fall, a restrictive Fed funds rate, and yet unemployment doesn't move. And he said the economy is really strong. The labor market is the strongest it's been in a generation, and that given the number of job openings, we shouldn't have to worry about unemployment going up significantly, so we shouldn't have to worry about recession. He looks back to 1994, the famous episode where Alan Greenspan pushed up rates 300 basis points, and he said, you know, we didn't have a big problem with unemployment then. We brought inflation down to around the 2% target, and it stayed there. He also thinks that yield curve, too much attention being paid to yield curves, because the 3-month 10-year is steepening, and you really have to have a long period in which yield curves invert. Right now, they're being distorted by inflation rather than growth feelings. So he said that things are much better than they appear for the underlying economy. It's just that inflation needs to be dealt with.
One view from the Fed, Mike McKee, fantastic. Again, just brilliant as always, and more Fed speak still to come through the week and through today. A little bit later, we hear from the New York Fed President, Mr. Williams. Then we hear from Daly. We hear from Mester as well. Through the week, you'll hear from pretty much everybody. Whaley, I want to come back to you. You used that phrase, that concept, the neutral rate. Where do you think neutral is?
Well, so far, what has been talked about is 2%. We think that's slightly lower than that. Probably is where neutral is. But to the point that was just made just now, that racing to neutral, getting faster towards neutral, we think that's absolutely justified. But it really is beyond that. What the Fed manages to do is important for risk assets. So we're really talking about a very narrow landing strip for the Fed. On the one hand, normalizing policy, but on the other hand, trying not to have too much impact on growth and unemployment. And that being the case, actually going too aggressively beyond neutral would be very counterproductive. And it's at some point we also have to talk about at which point 10-year, 2-year of yield levels would bring into question that serviceability that we have just taken for granted in this low yield environment, and also at which point the read across to equities is going to be contained, right? Because it's really remarkable that we're seeing incredible moves in fixed income, but equities are holding up really quite well.
Again today, Whaley,
developed world.
You see exactly the same thing again today, up 7 basis points on the front end equities. Fine. Gershon, I want to come to you on that. What is troublesome for the economy and what is troublesome for the market can be two different things sometimes, in fact, a lot of the time. When do you think this starts to become more problematic, more broadly for financial conditions and for this market?
Oh, I think the Fed does not have a very good history of engineering a soft landing. And I think the hope is that this time is different. And there are some differences this time. We don't have the excesses either in the consumer sector or the corporate sector. Actually, the corporate sector is in pretty good shape. We haven't had a long enough time period from COVID for companies to start doing what they normally do. They've been focused on costs, on shoring up their liquidity. They haven't been focused on share buybacks and M&A and spending up CapEx. So there are reasons to be hopeful. What I think markets are going to look towards are, where are we 6 months from now? Whether the Fed ends up hiking another 75 or 150, is it bringing inflation down? If it's not bringing inflation down, we're going to have real problems. I don't know what the definition of stagflation is, quite frankly, but we have to face, the markets have to face the fact that we're likely in for a period of higher than normal inflation, which we've been in, and probably if the Fed, takes enough liquidity out here, probably lower growth.
Equities up 1/3 of 1%, 20 minutes out from the opening balance. Yields are higher, much higher, up almost 8 basis points, 8 basis points on 10s, up 7 basis points on 2s to 218, just short of 219 at the moment. Whaley, Gershon, Eric sticking with us. Joining us now with your stocks ahead of the opening bell, about 20 minutes away. Here's Abby.
Well, John, helping that modest rise for the S&P 500 futures, we have some earnings and buyback stories to take a look at. First off, with earnings, Nike popping sharply higher on a less bad than feared quarter, especially relative to China. They put up a solid top and bottom line beat. One analyst calling it a big sigh of relief that supply chains didn't weigh more. Lots of price targets raised on the street. Alibaba soaring up about 10% as they have announced a $25 billion buyback to lift lift sentiment. Of course, this was the original China tech stock to drag down the sector. That crackdown, regulatory crackdown out of Beijing starting in late 2020 into 2021, started a 75% decline. You can see, though, today shareholders are relieved by this move. And then Carnival, they put up an okay quarter, and despite the rebound for travel and firmer pricing, some analysts think that they could be affected by rising, surging fuel prices. So the stock up just modestly, John.
Abby, thank you. Coming up, Russia expanding its assault across Ukraine.
We're on day 26. The Russians have clearly not achieved many or almost all of the objectives that we believe they were setting out to achieve.
The U.S. starting to see signs of desperation. That's next.
First step in building a connectome is to get your hands on some brains and then cut them up. It all sounds very grim, but Harvard turns out to be quite efficient with its brain harvesting. Jeff's lab can do a year's worth of research with a single mouse brain. Small chunks of the brain are fed into the slicer, where a diamond blade carves off a thin sliver of tissue. The tissue floats along some liquid and onto a piece of tape. The brain slices are then put into this very large machine, where they're photographed in the finest of detail. Software helps stitch the pictures back together into a single 3D image, and algorithms are applied to help make sense of what's going on inside of the brain.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Based on evolving intelligence, Russia may be planning a cyber attack against us. It's a patriotic obligation for you to invest as much as you can in making sure, and we will help in any way, that you have built up your technological capacity to deal with cyber attacks.
Another warning from the President of the United States, warning about a potential Russian response to mounting sanctions ahead of this week's EU summit. France's State Secretary telling reporters, quote, "We will increase pressure on Russia. If we need to impose new sanctions, we will do so." Discussions are underway. Maria Tadeo joins us now from Brussels. Maria, you know the topic of conversation right now for many people, it's crude. Can the Europeans agree to do something on energy this week?
Yeah, and absolutely, it's a big thing. But I would say, and I would really caution everyone out there, because there does seem to be a real mismatch between what we hear here in Brussels and what the market at time it's pricing in. Essentially, when I speak to my sources here, they say, of course, this is now back on the table. This is already, for many, a victory for the Eastern Europeans who really wanted this back on the table. Remember, a week ago, we weren't talking about this. The Germans managed, in many ways, to just like brush it and put it aside, saying it's a done deal. We're not able to unplug from Russia. Russia, and that's the end of the conversation. Well, the conversation is back, and it's back in a big way ahead of that big meeting on Thursday. But I would say, and I would caution everyone about this, is when I speak to my sources, and I've asked them this question repeatedly today, flat out, are we going to see anything that looks like a full, potentially even a partial ban on Russian energy imports? And they continue to tell me the same. There is no consensus for the time being, and every major decision has to be accepted by the 27 countries that form the European Union. To make things more complicated, you have the Hungarian leader, Viktor Orban, who's up for re-election in 2 weeks' time, who has a very complicated relationship with the European Union, but also a very close relationship with Russia, saying, I will flat out veto this because it will have an impact on my country, it will have an impact on the price of energy, and he doesn't want that before an election.
Maria, a busy week ahead for you and for the president for that matter as well. Maria Tadeo, thank you, joining us from Brussels. We often talk about the story sounds ugly, then we talk about the price of the story. And for some people in this market, the opportunities at the moment, crude higher, yields higher, the curve getting flatter and flatter, pockets of it inverting. Is that the kind of world you want to take risk in? Bob Michael at JP Morgan said this: we seem to have got a year of repricing in just a few months. Simply put, current valuations were too compelling to ignore. There's still reasonable risk, but it feels as though a lot is already in the price. Gershon, you're perfectly positioned to talk about this when it comes to credit. What do you make of that line from Bob Michael over at JP Morgan?
Yeah, I totally agree. I think a lot is in the price. You look at the corporate balance sheets, and as I mentioned in the earlier segment, we had a cleansing essentially of the corporate markets. The weaker players. It's a misnomer to think that COVID maybe it sped it up, but it didn't cause a lot of the defaults or restructurings. You had the E&P sector, which if they could have held on a little longer would have done very, very well. You had retailers. You had Hertz doing phenomenally well today. They had to restructure a couple of years ago. So you really, the weaker players are out of the market. And again, companies have not been aggressive. And you look at EM, I know everyone's so focused on Russia and Ukraine, but the market has just gotten decimated. It's actually now the sixth largest drawdown. In the 6 months following each of those previous five big drawdowns, the market has average returning, the hard currency market, over 13%. We think there are a lot of opportunities for corporates as well. So I wouldn't throw out the baby with the bathwater. There are some interesting opportunities. You do have to balance that. I think you have to respect the fact that curves are flat. And curves are flat, you tend to have, should be cautious on risk assets. But offsetting that, I don't think fundamentals have ever been better. And you usually don't see such a sell-off or a spread widening so early in a hiking cycle.
Gershon, when it comes to EM, just build on that a little bit more. Do you think China has helped to put a floor under risk appetite? Helped to put a floor beneath global growth, given what we heard from them last week, and ultimately how to put a floor underneath EM assets too?
Yeah, look, I have not made a career of trying to predict what China's going to do. I think they are quite unpredictable. I do think that, the default probabilities are low in most of these countries. And it's even perverse. Some of the countries, you look at Colombia, for example, that benefits from higher oil prices as an importer, and their spreads have widened considerably. So I think there's opportunity. Now, fundamentals have absolutely no correlation to what prices do in the short run. So macro news, whether it be on the economy or on the Russia-Ukraine situation, are going to make prices continue to be volatile. But if you have a little bit longer of a time frame, not days, but perhaps months or quarters, this seems to be a buying opportunity.
Eric, do you agree? You've talked about this higher interest rate of the Fed, that they can push it much, much further from here. How does that shape your thoughts about where market leadership comes from?
I want to pull out something Gershon just said about the spread widening in credit we've seen early in the Fed cycle and how unusual that is. You look back at the past couple tightening cycles, and really, you don't get into trouble on risk or credit spreads until very late in that tightening cycle. So from our perspective, if you look at the terminal rate and think that's maybe above 3% like we do, there's probably a long way between now and when we start to get really worried about risk assets. And the yield curve too, and thinking about, that's very close to inverting if you look at 2s, 10s, but you go back to the last tightening cycle, two tightening cycles ago in the mid-2000s, the 2s, 10s part of the curve first inverted in late 2005. The recession didn't come for another 2 years, and the peak in the S&P wasn't for another year and a half. So, John, from our perspective, there's still more room to run here in risk assets. And in terms of leadership, we still like those high-quality names in terms of quant factors, that's where we're looking. We're not ready to go dumpster diving yet. This is not a situation where we want to get really defensive, because I think at a macro level, we do see more room here for risk assets to grind higher.
That's the view from Eric Nelson. Wei Li, what's your view, the conviction call in this market right now?
Absolutely. So as we think about some of the macro factors that are playing out and the read across from elevated energy prices and energy vulnerabilities on economy, I would say that the U.S. is better shielded from energy vulnerability in comparison with Europe. So 2 weeks ago, we upgraded developed market equities and downgraded credit to fund that. And right now, it looks like, actually, given how well broader market has performed, having a bit of a quality pivot, having a bit of a pivot kind of towards the U.S. market at this point it makes a lot of sense, especially if you think about what is causing this focus and volatility in bond market at this moment is inflation. And over a longer term horizon, actually earnings, S&P earnings are highly correlated with inflation rates. So actually having that longer term exposure to equities, to S&P at this point makes a lot of sense, also from an inflation hedging perspective.
Wei Li, thank you. Alongside Gershon Distenfeld and Eric Nelson, to the three of you, thank you very much. About 7 minutes out from the opening bell, something really interesting happened yesterday. Yields were much higher, the curve was flatter, and banks traded lower. This just dropped from Bank of America. In the 90s, bank earnings were 80% correlated with the yield curve. Those correlations dropped to 17% since 2000. And today, our banks team cites the short end as more important than in the 90s. Now, that's about earnings and profitability. This is what they had to say on PEs. But the sector's PEs still move in lockstep with the curve. They say it's an overly simplistic reaction that ignores history and fundamental sector changes, and that might be the case. But the issue at play here is, yes, the yield curve might not shape earnings in the way it used to, but it still shapes investor appetites to the sector. So what's more important to you, the former or the latter? We'll get into that through the week. Coming up, the morning calls, and later, Mohammed Al-Erin of Bloomberg Opinion joins us at the opening bell. A choice between risking recession and prolonging inflation. That conversation just around the corner.
at the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Equity futures up 1/3%. Here are your morning calls. We begin with Truist upgrading P&G, highlighting the company's trusted brands and recent underperformance. Goldman downgrading Philip Morris, pointing to multiple risks emerging from the uncertainty in Ukraine. And finally, B of A upgrading Sherwin-Williams, given the company's strengthening pricing power. That stock up by 0.8%. Coming up, a choice between risking recession and prolonging inflation. It's Mohammed Al-Arian at the opening bell. Your opening bell is next.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
About 25 seconds away from the opening bow this morning. Good morning. Futures are doing okay. We're up 1/3% on the S&P, on the Nasdaq, up a little more than 1/10%. I keep saying they're doing okay, given what's happening in this bond market. We've got our teeth into that in just a moment. Let's see opening bow switch on the board. Let's start with Treasuries then. 10-year yields are higher by 7 basis points, 236.24. Pockets of inversion, as Mohammed would put it. We'll build on that in just a moment. This curve is flatter. 2s, 10s has been down to 15, 16 basis points, just a little bit steeper right now, up to about 19 basis points. In the FX market, dollar yen the one to watch, through 120. Euro dollar not doing much, 110.29, up 0.1%. And crude coming down 0.7%, 111.37. 22 seconds in, let's get you some movers. Here's Abby.
John, let's take a look at what is working and what's not, but for the most part, we do have stocks higher, as you were talking about, and one big stock that's helping, big name, I should say, Nike. Shares are popping higher after the company put up a very solid quarter on the top and bottom line beating, plus a sigh of relief that China was less bad than feared. Lots of price targets on the street raised. Tesla up about 0.4%, 0.5%. This as they are officially investing in a factory outside of Berlin, creates a global manufacturing footprint for the EV company, announced 2 years ago, and it will increase production of the Model Y. Now, oil just about flat right now, and actually down about 0.5%, as you were mentioning. Occidental Petroleum down 2.4%. This sector, of course, though, yesterday surged, Occidental in particular, so a bit of consolidation. And then banks yesterday, John, so interesting, as you had been pointing out, yields higher, but banks had been lower, probably in sympathy with that flattening yield curve yesterday. But today, Bank of America popping higher with the sector up 2.2%.
Abby, thank you. About 90 seconds in, up 0.4% on the S&P. Abby going through the banks and the energy stocks, financials top of the pile, up 0.9%. Energy at the bottom of the pile. The only negative industry group on the broad industry groups that I follow on my screen. Energy down about 0.4%. Information technology just about hanging in there, up 1/3%. But this year has been tough, given what the Fed's about to do. Let's get more with Bloomberg's Kaylee Lyons. Hey, Kaylee.
Hey, John. Well, this year has been tough primarily because of what we've seen in the bond market, and that was on full display yesterday. Yields shooting higher across the curve in response to the hawkish Chairman Powell over at the NABE conference. What's interesting, though, is yes, higher yields in theory put more pressure on higher multiple stocks, calls the value of those future earnings into question. And yes, the NASDAQ 100 did lag the S&P 500 yesterday with a 0.3% decline, but arguably it's not that big a move considering the scale of the moves we're seeing in fixed income, which raises a question of why the equity market is willing to look through it and why exactly it's behaving in this way. I won't pretend to have an answer to that. What I can look at, though, is history. And when you look at the sector performance during the last hiking cycle, so from December 2015 to December of 2018, technology actually was the biggest outperformer, up more than 50% over that time. You had utilities and discretionary hanging in there as well. Financials actually performed roughly in line with the broader market, even though the narrative is higher rates will benefit those banks. What's at the bottom end of the spectrum, more of those cyclical sectors, including energy, which was actually down over that time. Ultimately, the value trade didn't really get a boost from the last hiking cycle. And of course, the subsequent cuts that followed it didn't help either. And so we're still in a long-term trend of underperformance of value relative to growth, even though recently there have been more calls for value to outperform. Though ultimately where investors come down on either end of that trade, John, likely is going to be influenced by the assumptions made about whether or not the Fed can execute a soft landing or a recession is coming.
And let's talk about that now. Kaylee, thank you very much. It's not a secret for me to say that Mohamed Al-Eren is more diplomatic than I am. This morning, I'm saying he's coming out swinging. You judge for yourself. His words. Its credibility eroded. The central bank appears to have a choice between risking a recession or prolonging inflation. Mohamed goes on to say, the Fed is increasingly being forced to consider those two things. Which policy mistake it wishes to be remembered for? Meeting its inflation target by causing a recession, or allowing high and potentially destabilizing inflation to persist well into 2023. I'm pleased to say Mohamed can speak for himself when he joins us now. Mohamed, do you think it's that binary, one or the other?
I do, and I'm really worried about it, John.
Why is that? Why do you think there's not an optimal soft landing outcome that Jim Bullard was talking about earlier this morning?
So look what's happening in the marketplace. The whole point of forward policy guidance by the Fed is to bring along the markets in an orderly fashion. Instead, we're seeing the markets run away further from the Fed and do so in a disorderly fashion. And that is why the risk of a policy mistake is so high. When you lose credibility, you start chasing the markets, but the markets run away from you even more. And that's the dynamic we saw yesterday when Chair Powell spoke, and it's only a week after the FOMC meeting. Remember, John, the FOMC meeting was last week. We're having this dynamic now, and we're seeing it again today.
You use that phrase disorderly, that word disorderly. Mohamed, what about what you're seeing across fixed income and equity markets is disorderly?
These are massive moves, John, that come on the back of comments from a Fed chair. Yesterday, we saw massive moves. Today, we're seeing massive moves. That's what's so disorderly.
Do you think we're effectively capturing now what you think this Fed's going to have to do this year?
No, I think that if the Fed ends up validating what the market is now sort of tempting it to do, the Fed will end up breaking something in the economy. But if the Fed does that you and I have been talking about and I've been worrying about since last summer.
Can we deal with should and will and get through both those issues? What do you think they should do and what do you think they will actually do?
So I never would want to be in this position, right? And that's why you heard me advocate for them to take their foot off the accelerator last year and not continue injecting liquidity into this economy until earlier this month. But now that you're in this position and you're going to end up making a mistake, which is the high probability outcome, I'd rather make a mistake of letting inflation persist than throw this economy into recession.
And what do you think they will do?
I don't know, John. They've been flip-flopping all over the place. They are now coming across as incredibly hawkish. A few weeks ago, they were coming across as incredibly dovish. So I don't really know where they are. It seems like a roller coaster right now.
Do you think that's the problem at the moment, Mohammed? As you point out, we experienced this with Chairman Powell in December. I remember that, the news conference. He said a certain range of things, and I heard them, and the market didn't trade on them. Then we got the minutes, basically said the same thing, and all of a sudden we traded on them. And a similar dynamics played out in the last week. Hasn't really said much more than he said last week, yet as you point out, we've got these massive moves. Are you suggesting that the chairman and his words have lost credibility with some market participants?
So what I'm suggesting, John, will come as no surprise to you because I've been saying it for a while. They've lost credibility when it comes to inflation fighting. They've lost credibility in terms of their ability to forecast inflation, and they've lost control of their policy narrative. And that's why you're seeing this volatility in the marketplace every time we hear something from Chair Powell. They need to reestablish this. In the piece you mentioned, I go through how you do this, and it starts by being dead honest as to why you made such a big mistake and explaining to people why you're better at forecasting inflation. I don't think that the marketplace believes that the Fed is better. Break-evens moved against the Fed when Chair Powell was saying that he's very serious about addressing inflation. That shows you the lack of credibility that the Fed is facing right now.
Mohammed, what's interesting about the forecast is not just the credibility around inflation that some people are questioning, it's also their ability to forecast unemployment. If you go through the summary of economic projections, and I know you have done many times over the last few days, you'll see that 3.5% number for unemployment for this year and again next year. And what I see in the essence of your piece, the cost of reclaiming credibility over inflation fighting is ultimately damage to this economy. Does it make sense to you? I've heard words like fanciful, fantasy land, this idea that they get rates anywhere near high as they want to, Mohammed, without damaging unemployment. Is that even possible?
So it is possible under what I call the immaculate solution. And the immaculate solution is that somehow the US economy benefits from a big productivity surge, from a surge in labor force participation, from continued financial market resilience, and somehow this combination immaculately occurs and allows the Fed to deliver on the forecast that you mentioned. But you know, I don't believe that immaculate solutions happen every day, so I am concerned.
Where do you think neutral is, Mohammed? It's a phrase that gets thrown around a lot. Where do you think it is?
And I was fascinated by the discussion because people speak with confidence about neutral. There's two problems. One is that neutral has proven to be very variable. It's not a parameter, it's a variable. And the second is, how do you judge neutral, taking into account the fact that the economy and the market have been conditioned for years to live with very low interest rates? We don't know the dynamics of adjustment to higher interest rates. So, John, bottom line, I don't know where neutral is, and I doubt anybody actually can say with confidence when neutral is.
I'd make a further suggestion, Mohammed, that neutral for the economy might mean something very different when it comes to the market. I mean, when would it become a problem for the market? We're talking about interest rate hikes. Jim Bullard of the St. Louis Fed was on the program earlier this morning. I know you followed that interview with Mike McKee. He was talking about 3% on Fed funds by year end. We haven't even started to think about balance sheet reduction either. Mohammed, I'm looking at the market right now, and we seem to be taking this in our stride, in equities at least. Why do you think that is?
So that doesn't surprise me. If you're an asset allocator and someone comes up with the proposal that you should reduce equity, you're going to say, well, where do I go? Do you go into cash? Hell no. Inflation is at 7.9%, and I believe we may well touch 10%. You don't want to go there. That's a guaranteed negative real return. Do you go into bonds? Hell no. Bonds are adjusting. And it's a very painful place to be right now. Do you go into commodities? You go into Bitcoin, that's incredibly volatile. So you end up not reducing your allocation to equities, but actually looking to increase them. Now that works as long as we stay in a relative space. And we have been operating in a relative space. That's why stocks have been relatively resilient, incredibly so, in fact. The one thing that you've got to be careful of is that we don't switch regimes into an absolute regime. At that point, stocks become more vulnerable. But it doesn't surprise me that stocks are resilient.
Can you build out a little bit more on what would constrain risk appetite, Mohammed? You talked about an absolute regime. Detail what you mean by that. And also, can you throw in the yield curve as well? Should that constrain risk appetite? We've heard from the chairman in the last day or so. He said it wouldn't constrain them necessarily. Do you think it could constrain risk appetite in the coming weeks? Would you be comfortable being long equities, given everything you've said, given what's happening with this pocket of inversion emerging through the yield curve, 3s, 5s, 7s, above 10s?
John, look, if I'm investing over the next 12-month horizon, I would reduce equities at this point. I would take some money off the table. I think the market is giving you a wonderful opportunity to come out. And the reason why I do that is I don't think the market has factored in yet what's going to happen to the economy as all these changes start transmitting through the economy. So we are yet to see. My baseline, for what it's worth, is that we're going to see a global stagflation, lower growth, higher inflation. Within that, we're going to see depression in Russia and Ukraine. We're going to see a recession in Europe. We're going to see stagflation in the US. And we're going to see a number of commodity importing developing countries running into debt problems. That's the sort of world we're looking at, given the shocks we're taking. And the equity market hasn't quite priced that in yet because it's still thinking in relative space.
Mohammed, you introduced the S word. What does that mean? What does that look like? You've used another phrase in the past, stagflationary winds. What does that all mean?
So, first of all, the stagflationary winds have become much, much stronger because of what's happening in Ukraine and Russia. That is another stagflationary blow, and it is another great unequalizer. So we do have concerns for the most vulnerable members of our society and the most vulnerable countries. What does it mean? It means you'll see more and more downward revisions in global growth, more and more upward revisions in inflation, and policymakers are going to have less flexibility in responding. Increasingly, they're going to be forced into the choice that no one wants to make, which is which of the two do you target? We'd like to target both. We'd like to target high growth and low inflation, but the more stagflation takes hold, the harder it is to do that.
Mohammed, can we finish on something delicate? I said before the interview started that I'm more diplomatic than you are. That's true. We've been friends for a long time. You'd acknowledge the same thing. Say what you want to say now. If you had a question for Chairman Powell, what would it be? The chairman is still talking about last year as if it was somewhat of a surprise, even though people like you were warning about it quite a lot from the summer onwards, from about June time through the rest of the year. What would you ask him right now?
So I would ask him, isn't the first step of reestablishing policy credibility involve being open as to why the mistake was made? And what have we changed in order to make sure that that mistake is not repeated? Until we address this basic issue, the marketplace is going to worry about the same mistake being made over and over again, because that's what has happened in the last almost 12 months.
What did you make of it when the chairman said in the news conference last week, Mohammed, that this wasn't due to a framework shift, that he didn't want us to blame the framework shift for the reason they're in this position?
I was puzzled because I think there's broad agreement that the framework was well designed for a world of deficient aggregate demand, and we are living in a world of deficient aggregate supply. So I like that framework, but it's for a world that we no longer live in. So I was puzzled, and I don't think I was the only one.
Myself included. Mohammed, fantastic. Really enjoyed the piece this morning. Great read. Brilliant to catch up with you as always, buddy. Fantastic to have you with us on the programme for a decent amount of time this morning too. Mohammed Al-Erin of Bloomberg Opinion and Queen's College, Cambridge. Your market's doing okay, as Mohammed pointed out. Up another 0.6% on the S&P, on the NASDAQ, up by 0.7%. Coming up, governments and corporations alike ramping up the pressure against Russia.
He wasn't anticipating the extent or strength of our unity, and the more his back is against the wall, the greater severity of the tactics he may employ.
Bloomberg's Javier Blas joining us next.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
They've just launched their hypersonic missile because it's the only thing that they can get through with absolute certainty. He wasn't anticipating the extent or strength of our unity, and the more his back is against the wall, the greater the severity of the tactics he may employ.
That's another warning from the President of the United States. We've got to do a couple of things now. Speak to two of the best, two of the smartest individuals across Bloomberg Opinion and Bloomberg Intelligence on commodities, Javier Blas, and on China and debt, emerging market debt. Damien Sassa, I want to start with you, Javier. You sent me a message this morning. You wanted to talk about one thing, steel. So let's talk about it, Javier, right now. What's going on?
Well, steel prices are rising to a record high, already a record high in Europe, up between 150 and 250% from where we were before COVID struck. And what I'm really concerned is a lot of the focus with Russia and Ukraine is on the oil market, gas market, but steel is in crisis mood. And I can think of very few commodities that affect so many industries as steel does. This is the automotive industry, railway, construction. Everything is going to get very, very expensive. But what I fear the most is that we may have steel shortages here in Europe on the summer, particularly for construction. It is a crisis. It's going with very little notice, and I think that we need to highlight it.
Javier, the other issue that I think is still going without much notice as well is ags. I want to talk about that with you now. that if we can't get the farmers into the field in spring, we got big problems, haven't we?
We are going to have a big problem. Ukraine is a huge exporter of corn. Farmers are not going to be able to be on the fields, and the window is going to come close very, very soon. The farmers in Ukraine need to be working on their land in the next 35 to 60 days. If they are unable to do that, we will lose all the corn crop from Ukraine, which is a significant chunk of the worldwide corn crop, and that will put a lot of pressure come into the fall in the northern hemisphere. Come October, when we need to harvest that crop, it's not going to be there, and we're going to have to see much higher prices if that happens.
Javier, just awesome to catch up with you, buddy. Great work on this story. Javier Blas on Twitter, at Javier Blas, to follow this story. Pretty much the best out there when it comes to all things commodities. Damien Sasser, the best out there when it comes to credit and emerging market credit. Damien, we've been following the money. Have investors been getting paid? Have they been getting paid?
So far, so good, Jonathan. Yes, they have been. It's not easy, though. I mean, a lot of Russian corporates, Evraz tried to make payment on a coupon. Evraz, as you know, is 24% owned by Roman Abramovich. Societe Generale, the correspondent bank, has not approved the transfer to Bank of New York Mellon, so creditors are waiting there. Severstal is another. But yeah, no, Credit Bank of Moscow, which is a systemically important bank, did make a $9.7 million coupon payment today. What's interesting is investors, after Russia, the sovereign, made $117 million of coupon payments last week, Jonathan, we're waiting for another $66 million to clear this week. What's interesting about those bonds is they have the ruble fallback optionality. So they may actually be paying in rubles, not in dollars. And if that happens, offshore creditors may be blocked from accessing those rubles depending upon where their accounts are located.
Just quickly, have any of the events when it comes to payments over the last week, Damien, restored any confidence that you've lost over the last month?
You're asking me personally? Let's just talk about the markets. Forget about me personally. I don't own Russian bonds. But the markets, if you just look at 5-year credit default swaps as a proxy for sovereign credit risk, yes, you know, CDS has come in quite substantially to 1,900 basis points. I think it had reached over 3,000 basis points at some point last week. So it's coming quite considerably, but it is ticking higher again because, look, you know, how long can this can-kicking exercise go on, especially with the May 25th U.S. deadline looming?
And that's what it feels like for a lot of people, a can-kicking exercise. Damien, great work as always, buddy. Damien Sasser, following the money and seeing if investors are getting paid. And so far, they are. Coming up, your trading diary from New York. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
financials leading the way on the S&P 500, up about 2%. 26 minutes in, we're up 0.6% on the S&P. Helping out the financials, yields higher by 7 or 8 basis points across the curve. 10s right now at 237, 2s at 218.50 and very close to 220. That's the price section. Here's your trading diary. More Fed speak, Williams, Daily, Mester, all on deck. Data, durable goods, and another round of jobless claims coming up on Thursday. Plus, the president heading to Brussels for an emergency meeting with allies. That will take place later this week on Thursday. On Friday, he'll meet with the president of Poland. From New York City, this was the Countdown to the Open. Thank you for choosing Bloomberg TV.
Variant and the latest wave have an impact on not only consumer trends but your business? And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010, after staying for almost 1 year in the hospital. He died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
the price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Benegold as an opportunity to leave that troubled home. Benegold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Benegold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Benegold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Benegold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter. It's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just attacked that video and were like, you explain things so much better than my boyfriend or my professor, or I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350. Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million. Whoa.
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on